Hello everyone, and just a quick update on the property market outlook. I'm getting more enthusiastic actually because there's a whole lot of people out there, there's a handful of people out there sort of saying, such as the Valuer General New South Wales saying, maybe things will be a little bit flatter in terms of price gains going forward. I've been advocating for some time that we all need to be far more selective about the actual areas and the nature of the specific location of the properties we're looking at for investment purposes. I still think the investment outlook is very strong for the Australian property market. And yes, I do reference propertyclub.com.au, who have fabulous expertise, both in the overall tax treatment of your property investment and in terms of on-the-ground local knowledge. So that said, my objective view is the outlook for the Australian property market remains strong, but you have to be, as I've said for a few months now, more careful about your selection. And the reasons I'm still bullish are I've actually forecast the Reserve Bank of Australia will cut interest rates this year. They don't know it yet, but I often forecast what they will do a year or more in advance of them actually figuring out that that's what they need to do. It's not hard. Anyway, so I think the RBA, maybe they won't, but I think there's a very strong probability we could see at least one interest rate cut of 25 points from the Reserve Bank this year, in the next 3 months or so, despite what the Reserve Bank is saying about wanting to hike rates. And it's been very clear about that intention and that desire, which goes completely at odds with the state of the Australian economy. And it goes completely at odds with thinking that this little bank in Martin Place can control the prices of goods and services in a slowing economy, an almost dormant economy. I mean, all the growth is coming from government spending. So an almost dormant economy on the private side, flatlining in fact, and they think the problem is an overheating economy causing inflation and they have to cool the economy. That's a nonsense. So they will eventually figure this out, but they only tend to figure it out after the Federal Reserve has figured it out, and the Federal Reserve in the United States has figured this out with a large interest rate cut of 50 points 2 days ago. Now, during COVID, you could say that the RBA basically plagiarized anything the Federal Reserve said on their interest rate decision meetings. It looked like a copy and paste on several occasions during the GFC. But of course, a lot of central banks were reacting to the same stimuli. But I do think that the chip on its shoulder, Reserve Bank of Australia and Security Complex, does take note of what the Federal Reserve is doing and other major central banks are doing, and probably is going to start to incorporate some of the Federal Reserve recent language into their own views and musings, wanting to sound all very clever, like an international central bank. In other words, what I'm saying is the writing is on the wall for the Reserve Bank of Australia to slowly shift towards a more neutral and then a rate cut. We will see 2 rate cuts, I think, within the next 6 months. I'm thinking we can get one in by the end of the year. As long as the economy doesn't tank too badly, it'll be one. But I think we definitely should. Well, I mean, I've argued for some time now we should have already had 3 interest rate cuts from the Reserve Bank of Australia. And the argument for that's economically and fundamentally very, very powerful. It's just that they can't see it. So if you're looking at the property market, note this. The employment number was pretty strong. It was up 47,000 new jobs this week, and that's a good number. Unemployment 4.2% is not a good number, but it's not a shocker of a number either. So there is a chance here the Australian economy is going to kind of muddle through with government spending disguising the slowdown in the aggregate data. But I do think from a private sector point of view, the Australian economy is probably already in the first quarter of a recession. We haven't got the data yet. But from an aggregate economic outlook scenario, including government spending, it's just going to hold above or be flat or only slightly negative. But the real situation for the private sector is worse. But we're not seeing runaway unemployment, which allows people to maintain their mortgages, which allows the property market to remain reasonably supported. Now, I've said for some time the major driver of the Australian property market moving forward and why you have to be so careful about the location of your property investment is immigration. The other major factor is that the top 10% maybe 15% of the population who held equities, stocks, and property coming out of the GFC. Sorry, not out of the GFC, out of the GFC too, but out of COVID. I've been around a while. Coming out of COVID, if you came out of COVID with property and shares, you've done very well. All right. Although the last 3 years for the Australian property market, this is something to keep in mind as a for the stock market, something to keep in mind as a property investor, is that the stock market's only averaged around 2.8% per annum over the last 3 years. And inflation has been higher than that. So being a property investor far outperforms stocks, regardless of what your stockbroker might want you to believe or your financial advisor over the last few years. That said, going forward, I think the equity market's very tied up here. The Fed's finally cutting interest rates. The market just hit record highs in the US. But I think it looks a little fragile up here, and we all know equities are really quite overvalued. And when you think about the equity market in Australia, it has come a long way over the last year after a big dip. So the average over the 3 years isn't great, but it's been a lot of ups and downs. And the economy is slowing, and our relationship with China is not exactly brilliant at the moment, which means they shop elsewhere where they can for importing goods, commodities, resources, which isn't good for us, but still we have a strong relationship, but it's a weakening strong relationship, if I may. So I just think there could be some shift from the equity market back into the property market as people recognize that property has been a very firm performer. In fact, it had a bit of a dip in 2018 and again around the end of 22. But otherwise, median prices, average home dwelling prices have all been rather bullish the whole way through. There could be a slowing in the pace of gains, but I'm thinking 2 to 4% price gain growth for places like Sydney and Melbourne are not out of the question. I think the southeast corner of Queensland has been very strong for many years and spoke about it many years ago. It may be slowing some consolidation there, but still a reasonably firm market. So once again, I'm seeing a slowing Australian economy, but with unemployment edging higher. It's probably going to go up to 4.5%, but that's not a real crisis level. And with high government spending, the overall aggregate data for the economy is going to be buffered a little bit. I just see an extended slow economic growth period with interest rates being cut and with immigration still through the roof. And remember, the immigration we've already seen has a 2 to 3, maybe even 5-year lag effect in terms of coming through into property purchases. So I think the property market is supported for the next 2 to 3 years quite well, and maybe probably beyond that if the global economy regains its traction over the next year or two. In a nutshell, what am I trying to say? I still think property is a good investment. I really do. I think it will outperform stocks. I hope it helps. Have a great day. Thank you very much.